Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
One of the questions I was asked when I was originally starting this presentation today was, about whether, since currencies tend to revert to the mean, they don't grow forever. They're not designed to grow forever. So is it really a trending market? Can we really treat it as a trending market? I would say yes, but just really, it's really a different kind of way. It's a different way to look at your investing. So, as an equity trader, I will oftentimes pick up stocks for the long term, years, potentially. But as an options trader in the Forex, or even as a Forex trader, we don't always look at it that way. It's fairly short term. So when I'm looking for a strong dollar trend, I'm not really looking to evaluate and try to forecast, well, for the next 10 years this looks good. There is no management team I can evaluate. There is no, I can't look at its market or competitors or its barriers to entry, et cetera, that we might do with an equity. So instead, I'm looking at the intermarket environment to give me a heads up as to whether or not the trend is going to become unstable between now and in the next 3 or 4 months, which means that if we're buying options, that's typically the horizon that we're buying them for. Let me shift gears here just a little bit. I was chatting with Stephen before I came on the presentation. We were kind of chuckling about the amazing movement on the Aussie dollar, which has resulted in record levels of implied volatility. So we've got volatility just at extremes, haven't seen for a long time on things like on the Australian dollar. And I find that there's a lot of traders out there who are saying, well, okay, so I get the whole thing about the dollar getting strength, and I'm looking at all of my dollar indicators, things like yields, volatility in U.S. equities as represented by the VIX. So what else should I be looking at? And what I always say is, well, it's kind of a two-part answer because, first of all, I think that the dollar Aussie is actually a good example of this because the dollar Aussie devalued so quickly and so fast, we have to kind of stretch out and say, well, what would cause that? Is it just a matter of dollar weakness, or is it or dollar strength, or is it a combination? And what we find is that with currencies like the Aussie that have been built up around two bubbles. One is a yield bubble. They were offering very, very high interest rates for a long time, very popular component of a carry trade. But two, it's very sensitive to commodity prices, which also ran up into a bubble. So we get the simultaneous break of both the dollar breaking out to the upside because of uncertainty, as well as constraints on growth or declining growth, which was, we've got two of our factors that we were looking at. And then you have flow and capital in the middle, flow of capital from one asset class to the next in the middle of that, and you spell a recipe for disaster for currencies that have been in a bubble themselves like the Aussie. Now what's interesting about this is that, that there are, obviously one of the things we would want to look for when forecasting the future value of the dollar would be, well, what's going on with commodity prices? Are commodity prices continuing to be fairly low? Or are we beginning to see a little bit? Are we beginning to see a little bit of economic growth and therefore some appreciation in those commodity prices? Because that's likely to help the Aussie, and in this case, force it back down against the dollar. Now, so that's a good question because we're kind of talking about two markets that have really been extremely volatile over the last 12 months. We got the dollar and we have commodities, and when we put those two together, we kind of have a recipe for, we have a recipe for disaster, which is what
Can everyone hear me? This is Steve Meisinger, your host. Looks like we've lost John. His phone looks like we've lost him.
Steve.
Okay. Hey, John. Good. Yep.
Okay.
Looks like for some reason we lost you, but now you're back.
That was weird. Yeah, that was weird. Just because maybe I should have used my cell phone. Just kidding. So I apologize, everybody. My WebEx, so it beeped at me just as I was being kicked off. So I think I know exactly where I was when we stopped. But again, sorry about that. As you saw, I was looking in my Gmail account for the number again. So so anyway, let me jump in here again. I think where I was, we were looking at the Aussie, which has kind of been hit with basically all three factors that are driving the value of the dollar: falling commodity prices, a flow of capital into safer or higher quality assets, and a shifting in risk because of all that uncertainty. So there's a shift of that uncertainty is making the dollar attractive as a shelter against that uncertainty. Well, I always am very interested in bubbles from a trading perspective. Anytime we see the market just really respond, we're as traders, we're keen about saying, that it's over-responded, it's oversold, it's overbought, whatever it is, that the market has responded too much. And one of the byproducts of that is, of course, that for aggressive traders, there's an opportunity here, because fear is so high, to get in and try to make a little bit of money off of that uncertainty. So, and I was going to use the Aussie, or the dollar Aussie, as my example. I've drawn a couple of lines here because just before I got on the presentation, I was curious about how much would a straddle cost that was for November expiration, and the total cost was $16, so we have this 32-point range between where the market is right now and those top and bottom barriers, which is very interesting from the perspective of being a option seller, because we don't have to necessarily hold it all the way through till November expiration. If volatility starts to begin to decline, so if we see the VIX beginning to peel off of those highs, like it did to a very small level today, then we can start to, we have a little bit of an opportunity where we don't really care what direction the market goes on the dollar Aussie. What we're really interested in is whether or not volatility will begin pulling out of that market, because as a option seller, that benefits us because the inflation comes out of those premiums, and we could then buy it back for a cheaper price than we sold it. So all things to consider as we look for one opportunity versus another. I have one other comment that I wanted to make about forecasting the future of the dollar, and this is kind of a nod out there to all the technicians, guys who like to use technical analysis and are looking for, wrong one, are looking for, well, what are a couple of ways that I might be able to forecast what's going on in where the dollar might go. So I'm going to bring up my dollar index again.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.